Welcome back, everyone. Michael here with Offshore Citizen. Today we're going to dive into the important subject of investing, and in particular an investing subject which is relevant to the stage that we're at in the cycle, kind of the current market conditions. And that is some particular non-correlated alternative investments. And so I'm going to fill you in a little bit on one of them in particular. We're going to talk about a bunch of them, but if you're in a situation where you have assets, you need to kind of be growing them, multiply your wealth. To give you some quick number, actually I'll do this after the little thing, and explain kind of how that pays off. But you should be listening to this. There's some great opportunities out there that most people are not aware of, so stick with us till the end. With that in mind, if you have not done so already, please click the subscribe button, click the notification bell. We're trying to build our subscriber base. If you like the video, please share it with your friends. Click the like button, let people know. We really appreciate it. And if you'd like help on any of these issues to do with international, with wealth, with finance, etc., so international tax planning, like legally reducing your tax, with asset protection, with company formations, etc., as well as we can have conversations about this investing, etc. You can book a call with me, clarity.fm/Michael Rosmer. There's a link below, or check out our websites, offshorecitizen.net, offshorecapitalist.com. With that in mind, let's dive into it. Okay, so here's a little simple sample statement, okay? Let's say that you made $60,000 a year and you managed to save all of it, okay, for 30 years, all right? So $60,000 a year for 30 years, that's $1.8 million you save, all right? And this would, kind of represent the life cycle of a typical person's income, right? So over the course of 30 years, which is, okay, maybe their career is slightly longer than that, but, they're also not saving their full salary for sure, and, definitely not $60,000 for most people. That would leave them with $1.8 million if they just saved, okay? Let's imagine that instead of saving that $60,000 a year, that along the way you invested it, and let's say that you managed to get 20% a year returns. Now, to be fair, very few people are going to get 20% a year over 30 years. That would be a pretty amazing return. But how much money do you think they would have instead of 1.8 million? The answer is about $99 million, okay? So just keep in mind that 30 years from now, 1.8 million is probably not going to be worth that much. And so even if you saved all of that, you're probably not going to be in a very good situation. Okay, so let's say that you're 30 now, 30 years later, you've saved $60,000 a year on average. Well, in this case, it doesn't matter. On average, you're at 1.8 million, not so good at age 60, right? Obviously, if you're older, you have less time to save, but maybe you've already got some savings added up, etc. By doing it at, like I said, 20% a year, 99 million, that's a really big difference. To give you some contrasting number, if you did 10% a year, I think you end up with around 12 million. Okay, so the bottom line is you should be investing your money. I have lots of clients out there who they earn good income, they have an online business, maybe they did something in crypto, etc. And that's great, but their money is just sitting there latent. They've got a few $1 million cash in the bank, and what's it doing for them? It's doing nothing. So one of the things that we try and help people out with is think of asset protection in terms of hedging against inflation, in terms of what you can invest in, etc. And you want to do that. So now this brings us to the question though of where do you invest, right? So normally at other stages of the cycle, maybe you put your money in the stock market, maybe you buy bonds, maybe you buy gold, etc. Well, let's just look at that. I mean, the stock market is near all-time highs. Bond rates are zero, or basically that. Gold near all-time highs. Usually what is the basic rule of investing? Buy low, sell high, but you're now buying high, and who knows how much higher it will go, right? So the risk to reward in the current environment is questionable. Obviously there's lots of stimulus, so there's reasons that maybe the market would continue to go up, but is the S&P 500 or the Dow Jones going to double, triple, let alone 5x in the next 5 or 10 years? No, certainly not going to 5x. I think it would be unlikely that it would double. So that's a bit of a problem. In fact, arguably, some people are making the argument that we may see a lost decade where the market is basically just flat for 10 years, right? The flip side is similar sort of thing. Maybe, maybe you'd see a little bit more gold if you see some sort of inflation spike or something like that. But there's a reasonable possibility that, again, from all-time highs, what's it going to do? You're certainly, the worst case scenario, you've got no cash flow off of that. You could buy real estate, but the whole real estate market dynamics are changing. I've talked about this in previous videos. So, the amount extra that you can gain, you can certainly do. There's a bunch that can be done in real estate, but, how compelling is it? Not necessarily that great. Bonds are horrible. So I have been advocates of private debt. I think there's a portion of your portfolio that you can put into real estate. I think there's a portion you can put into gold. I think there's a portion you can put into a variety of things. And I don't think that's a bad idea to invest in targeted stocks, etc. either. But I think that putting all of your eggs in any of those baskets is probably a bad idea. And what you ideally want is you want to diversify into some non-correlated assets. What does that mean? Non-correlated assets are, so a lot of things tend to flow in the same way. So what did we see, for instance, well, let's just talk about stocks. When the whole market crashes, almost everything tends to crash. Okay, so, and when the whole market goes up, most things go up. There's kind of an expression that when the market goes down, 90% of things go down. When it goes up, 70% of things go up. Okay, so that's all of those. Even if you diversify, they're kind of similar. Real estate, you can end up with something similar situation. Maybe you buy 10 properties, they're probably in a similar region. If the macroeconomic factors come in that jobs aren't there, people are leaving, etc., well, all those properties are likely to be down, right? So although those things are good, right, I think it's certainly fair for a person to put, I don't know, 20 to 30% of your net worth into any of those different particular baskets. Probably it's good to diversify a little bit. And that brings us to our first subject that we're going to discuss today around the subject of alternative assets, and this is investing in film. So this is a really interesting one, right? Not many people know about it, but it's potentially actually a really good investment. And why do we like it? Okay, so how does film investing work? So first of all, like anything, it's not about the asset class. People who are focused on asset classes don't know what they're talking about. It is about finding the good deal. But the point is that the deals in film don't necessarily correlate to what the deals are in other fields. So you can get great returns in film when everything else is down. It basically just has nothing to do with each other, and potentially could be inverse too. So in other words, when the stock market goes down, film could be doing well because people are kind of depressed and they're going to go see more movies, right? So what do you want to do with respect to film? How does film financing work? Well, normally there is two portions of it. You put money in. That money might be tied up for, let's call it 18 months. It depends a little bit on what the production time is and how early you put the money in and things like this. But, and that money is more or less going to be loaned out, right? So it would be normal that you say, okay, great, I put the money in and 18 months later I get, an 18 or 20% return, okay? This is not great, not terrible, right? It's decent, right? You're like, okay, great, I did, about 1% a month, and okay, that's not bad. But the flip side is that on top of that, you can get a royalty, okay? So if the film or TV show or whatever does well, you could potentially be getting paid for 10 years down the road. In some cases, if it's something that really has a lot of longevity to it, 20, 30 years down the road, you could continue to get paid. So that's pretty awesome, right? Essentially what you're saying is if it's structured properly, it's basically a debt investment, right? You're getting a reasonable rate of return on that debt, certainly perfectly good. And then you're holding a lottery ticket that you might have some other upside. So I like this kind of from the barbell strategy. I've probably talked about this, which is the idea you're trying to minimize your risk. You say, hey, what's the worst case scenario? If you do it well, your worst case scenario hopefully is you keep your money and you get a bit of return, right? This is kind of like if you own property that's, and then you're getting rental income, right? It's like, okay, property over the long period of time probably is going to remain stable. It's probably not going to drop too much, but you're going to continue to earn rental yield. Okay, that's good. On the flip side, you want some upside, right? So in the case of real estate, the appreciation is the upside, right? It might appreciate, it might not. You don't know by how much. If you leverage that up, that can add up to quite a lot. Same sort of idea in film, right? You say, okay, great, I'm putting the money in. Hopefully, if I did my due diligence well, et cetera, the chances that I'm getting my money back plus a rate of return is very, very high, right? And then I'm going to go and I'm going to say, okay, on the flip side, I may end up with royalties that could add up to something. Now, that's an uncertain thing, right? You don't know this part. This part is pretty predictable, easy to control, right? You can have a reasonable idea where you're going to end up. This part, you don't. This part, you can do your best bet, but who knows? So that's more or less how it works, and I think is, kind of interesting. Now, a few things about this. So a lot of people might say, hey, well, hang on, isn't film risky? Don't a lot of films lose money, etc.? Yeah, this is where deal structure comes in, okay, and picking the right deals. So in film, you can very often structure deals where you're last money in, first money out, okay? So that's very good. In other words, It's one was brought to me a couple years ago. It's about a $17 million production, okay? And you're talking about putting in the last $1 million, okay? So it's like, okay, they're already mostly funded. They have tax credits, they have major investors, etc. You're putting in that last $1 million, okay? So at that point in time, it's not like if you're putting in the first million, well, you may never get to the point where you actually produce the movie or whatever, right? Here, it's like, no, this is just the final hurdle, and that's good. But they need it, so they're willing to give you good terms. So then on the flip side, as soon as money comes in, you end up being the first person to be paid out. And that's very helpful. Okay, so what does this do? This radically reduces your risk, okay? Radically reduces your risk. Second of all, what often happens is that a bunch of the funding comes from tax credits, okay? So there's a lot of tax credits available. That's going to ensure that as a percent, like the amount of money that they need to make in order to recoup the budget is fairly low, right? On top of that, they may pre-sell it, right? So they go to various different markets and they pre-sell those markets so that, hey, listen, at such and such milestone, they're going to get, let's say the Asian market is sold out, right? So there's a lot of things that if you do this well, and if you're interested in this, contact me, and I can put you in touch with some people who are experts and who have a very good track record of making quite a bit of money on film and not losing money, which is equally important, right? So you can take that and you can say, okay, perfect, great. Like our chances of losing money are very low because we've structured the deal properly and because we picked the right deal. It's produced in the right location, etc. And then, like I said, on the other side, it can go up. Now, let's talk about the last part of this, which is I have some friends and clients who have invested in various film at certain periods of time. And the truth is that if you want to have good risk to reward ratios, usually the projects that are going to fit that criteria are not sexy, okay? It's not the ones with the big stars, it's not whatever. It might be a $3 million budget for producing a TV series, right? So we're talking about, the stuff that Discovery Channel is gonna run a series on. It's kind of like Phil, where they always need new content, etc. So they're always out there looking for it. They're gonna pay X per episode for that. And, it's not gonna be, you're not having big stars, you're not whatever. The idea is to be able to produce this cheap, to be able to get it out well, to have kind of a nice hook, and hopefully it goes pretty well, right? So if that's the case, right, what's the allure? Well, it's not the same as if you go and finance the next blockbuster, right? On the other hand, some people, what they want is the prestige. So there was a film that was brought to me by some people, again, like a couple years ago or something. You've got Oscar-winning stars, etc. And so in that case, maybe you're saying, hey, listen, I'm going to put in, a couple $100,000. And part of the thing that I want out of this is I want to go to the premiere. So I want, tickets included. I want to go and hang out on set. I want to have a executive producing credit. I want to, you can negotiate these things. And so for some people, that's really appealing, right? They can come and say, oh, hey, I was involved in the production of this movie. I got to go meet these stars. I got to whatever. Generally speaking, those movies, the risk to reward ratio, they tend to be, higher risk. And, so the likelihood that you're going to make your downside protection is not quite as good. But on the flip side, you have the cachet that goes along with it. So both of these are options. If you want to learn more, reach out to me. I have some people who I can put you in touch with, and I think it's quite interesting. One of the things that is especially interesting is, again, in a time when the market is quite high, this is a pretty reasonable way to diversify. I wouldn't put, a large portion of your portfolio, but, for instance, maybe you put 10% of your portfolio into this. So, okay, great, you can do that. But the other side of it is that there has been a lack of production. So the people who can produce, because of the nature of how they produce, etc., maybe they're in animation studios, maybe they're able to, they're in environments that they can make it work based on, pulling together, again, footage from a variety of disparate sources. They don't need to have that in-person filming. I know people who are in the film industry, and it's kind of picking up in a bunch of areas, but say you were there, not such a big deal. So anyway, there's actually a reasonably good opportunity right now in that industry is what I'm saying. So if you're interested in this, or if you like this video, please click the subscribe button, click the notification bell. Definitely love to hear from you. Click the like button. And if you want to get in touch with us, you can book a call with me, clarity.fm/Michael Rosmer, link below. You can go to our websites, offshorecitizen.net, offshorecapitalist.com, And yeah, we'd love to hear from you guys about anything you'd like to see, and I'm going to see you guys on the next video.